Hi, folks. Welcome back to Money and Politics. It's kind of a tough day to be welcoming people back, but I'm coming to you now with about an hour left in trading on Monday, the 24th of January. I wanted to come to you because I haven't been able to give you an update for a while, and I wanted to touch base before I got swept under the rug again. We have a tough day in the market as I tape this. I'm sure you know it's a tough day. The S&P is down 1.6%, the Dow is down 1.4%, and the NASDAQ down 1.6%. Some of the markets the decline is starting to level off a bit. We'll have to see how that goes. With an hour left, we could take another deep dive or we could bounce back. A couple of things I would talk to you about. One, and I've showed this to you before, a lot of things I've talked to you about before, I'm going to repeat here because I think when you're in the midst of talking, hearing some of the things I say, but when you're in the midst of a sell-off like this, what I've said to you before is going to make a little more sense on days like this. And this is where on December the 6th, I talked to you about things that could go wrong. And one of the things we're worried about are on these lists. Things we're worried about today are on this list, including rising interest rates. And we got a Fed meeting coming up, I think, in the near future. China attacking Taiwan, as I've said back in December 6th, if that does happen, and I hope to God it does not, that would not come until after the Olympics in February, so that'll be happening soon. Putin invading Ukraine. Again, I created this graphic on my video of December 6th, and I went over some of the concerns I had at that time of things that we were facing and could impact the market in 2022. So there's the list. And I also added what could go right. And what could go right is that some of the things I talked about don't happen, including that interest rates rise because they will, but they go up modestly and not too fast, that the lockdowns end, and that throughout the course of the year we get a global recovery. Now, we have a strong sell-off today. It's been tough for a while. Here's something else I've shown you before and want to remind you of. I'm going to take myself out of here. And this is that 50-year chart of the S&P 500 from 1970 to 2020. And this is I bring up as a reminder of we had a lot of downturns. You can see a number of sharp downturns there happening. And when it happens, it seems like, oh my God, here we go. This is it. This is the big one. We're going back into the depression. And what I want you to see and keep in context is that over time, the markets bounce back. And when you are in the midst of a storm, I want you to remind yourself that the storms don't last. And just like the rainstorms and the thunder and the wind howling can seem frightening at the time, you know that they don't last, and the storms on Wall Street don't last either. One of the things I've talked to you about, both on December 6th and on January 5, is that there are things that you should be doing. And what I've said is that you should always have 10 or more percent of your portfolio in cash. And the reason I've said that, I'm just saying as a reminder of what I've told you before, is when the market sells off like this, you're going to feel better if you've got a pile of cash in your portfolio. You're not going to panic and be selling good stocks at bad prices. You're going to know, hey, I've got cash on hand, I've got my bases covered. So that's number one. Number two, you have the money to buy things that you want to buy when they go down without having to sell other stocks. If all your money is invested and everything goes down, you don't have the money to go in and buy bargains unless you go out and sell other stock in your portfolio, which is also then you're selling at a low price. So this is the other reason to keep cash on hand, so that if you want to go in when the market sells off and buy things, you can do that. So I've talked many times to you about INMD. It's gone, let's take a 1-year chart here. And you can see it had gone up consistently. Now, since about November 4, I think is about when it topped out, close to $100. It obviously has sold off a lot. To put this in context, however, we're back to where we were about June the 5th. So I still like INMD. And why do I like it? Well, because they consistently are growing their revenues and they are consistently making money. We're going to get the fourth quarter earnings coming up here shortly. When you look at these earnings dots, the green, all those green dots are where when they came out with their quarterly earnings, they exceeded expectations. I think they're going to do that again. You look at, again, this is getting to be pretty dated here, but we need to get the 2021 numbers. And we will be getting the 2021 numbers very shortly. On February the 10th, we are going to get the final earnings for 2021. And where 2020, as you can see, was $206 million. As a reminder, we were told in preliminary earnings report that InMode is going to have revenues in the area of $357 million or so. So a huge increase in revenues. And I expect a good increase in earnings too. Earnings in 2020 were $75 million. I think we will be over $100 million. That was what they were reporting, that we're going to be in the area of about maybe 115, 120 million. So when you have a company that is consistently growing and they're making great margins, that's what you want. That's what you want. So, that would be something that I would say you want to buy. And again, you want to have this for a number of years. Now, I've also talked to you, by the way, let's take a look at Humble. We always expect to take a look at Humble on my channel. So we've been to here before. We were down to 21 cents, I know, before, and you can kind of see going back to about, mid-December or so, we were down about this level, came back up. So, we came back up from this point before, 21, we came back up to where it was quite a significant increase in value, let's put it that way. And on the volume, we got a heavy volume today, so close 9.8 million shares. That's about in line with the average, a little bit more. We're waiting for the earnings on Humble. Someone asked me, do I have an insight into what I'm expecting on the Humble revenues? And I should say revenues, not earnings. What am I expecting? I don't have any idea on what it will be because this is going to be, as I've said before, the fourth quarter of 2021, when we've had a number of their business lines open for business. And so it's the very first time. This is going to be kind of the benchmark by which then we will compare some of the other quarters that follow to see, are they increasing revenues or are they not? So I don't really have too many expectations of where it's going to be. We're going to have to see. The other thing, and this is obvious, but sometimes we forget the obvious. One of the things Humble is dealing with is ticket sales, and obviously we're dealing still with this Omicron, the whole COVID thing. It's global. We know that. So of all the times for someone to launch a business, it's not been the greatest time over the last year for Humble to be launching their business when we've had the whole COVID thing going on. But, when I tell you to look to the future, there's a solid reason. I always have a reason that I'm telling you these things that I'm telling you. It's not just something I'm just, picking out of the sky. Now, the other thing I did talk to you about, both on January the 6th, or I'm sorry, January 5 and December 6, and I have to bring it up here, is the way to hedge your portfolio is you can buy a leveraged short. So whereas the TQQ is 3 times the NASDAQ, the S, as in Sam, QQQ, goes up when the market goes down. When the NASDAQ market goes down, the SQQQ goes up. And that's why you see it today up 3%. Now, if I go to 1 month, and let's go back to the chart from about January 5, here it is here. So we were at $32. By the way, the SQQ recently did a 5-for-1 reverse split. So if you go back and look at my January 5, and it says the SQQ was $6 and change, you have to adjust that for the reverse split. So that $6 becomes $30. So back on January 5, we were right at about $32. Come on, there you go. Which means that we're at $43 here. Just went over $43. So we're up roughly 30% in less than a month. And that's one way you could do it. Now, let's talk about the TQQ, or is the S&P 500, 3 times the S&P 500. I'm sorry, let me stop that. I misspoke. The TQQQ is 3 times the NASDAQ 100, okay? 3 times the NASDAQ 100 index, which means that when the NASDAQ 100 goes up 1%, the TQQQ will go up approximately 3%. And the SQQ we're looking at here is the reverse. So how do you play a market sell-off? Well, number one, we don't know where the bottom is. So when we get a sell-off, probably the best thing to do, one thing you could do is, if you want, buy a little bit. But here's how you use the SQQ. The SQQQ is only to be used for relatively short-term investments. And that's because normally your downturns are not going to be long-term. We certainly hope that. Let me bring that 50-year chart back up. You can see that the downturns could be sharp, but relatively speaking, they didn't last. So you want to say that when you're buying something that, like the SQQQ, where you're going to go up in value as the market goes down, I wouldn't put a whole lot of money into the SQQQ, because in the long run, it would be a losing bet, because I would not bet about the American stock markets, in this case the NASDAQ, to go down and stay down for a prolonged period of time. So when you use the SQQ, it's a short-term tool to make some money in the short run when the markets are selling off strongly, okay? Now, when you have the market sell off, and if you have your cash pile there, and if you want to put some of it to work, buying the TQQQ or the UPRO, which is the UPRO is the leverage version of the S&P 500. the long, that's betting that the S&P will go up. Obviously, the time to buy those at a good price would be when the markets are down. So again, if I look at this S&P 500 50-year chart, when we had those sell-offs, and you kind of stand back and you want to wait a bit and see when is the sell-off going to stop? And that's not necessarily in one day. You want to stand back and see when the market hits a bottom and see if it comes back off the bottoms, not for one day or just 2 days, but maybe for a week or even 10 days or 2 weeks. That's a better indication of have we stopped falling. And presuming the market just didn't shoot back up to all-time highs, then that would be the time when the market has come off the bottom that you could buy the leveraged version of the NASDAQ, the TQQ, 3Qs, and you could buy the 3 times leverage version of the S&P 500. When we get these sell-offs, that way you're positioning yourself for superior growth going forward. And again, that's where you want to hold on to those for some time. And as I have talked about over the last 6 months or so, when you get a lot of investments, I told the example of a friend of mine where when COVID hit, we were buying the TQQ for her portfolio. I was talking to her about what she might do. And she was buying right after the COVID came and we hit rock bottom around St. Patrick's Day of 2020. And she started buying the TQQ in that period of time. Her $7,000 that she put into the TQQQ around March of 2020, by the early part of 2021, her $7,000 had gone up to nearly $30,000. So as I have said, over the last 6 months or so, when you get a position that has gone up significantly, as my friends did in the TQQ, that's where you want to be taking some money off the table. It doesn't mean you have to close out an account all the way. It does mean that you may want to, here and there, whether it's the TQQ, whether it's InMode or IBM, you want to be pulling some money out of the market here and there as you go along. Especially, and this is why, folks, again, as a reminder, why I called the channel Money and Politics is because they are so intricately connected. And this is why I'm reminding you of what I had talked about, my concerns for 2022 earlier, when I could say, or when I was saying back in December, what could go wrong this year, and I made this list, that you have to be looking at the environment, the investment environment that you are in every year. You can't ignore what's going on in the world. And so are we about to go to war? Is everything good? Do you have a pro-business administration as we had with President Trump? Or do you have an administration, the Biden administration, which is not good for business in my estimation, and the estimation I would say of most business people, where it's causing the price of oil to go up. And then when you got to look at what's going on with the Federal Reserve. We are coming out of an environment where we have had historically low interest rates. They're going to be going up. Now, what we don't know is how precipitous is the increase of interest going to go. A lot of people think it'll go up, but not necessarily terribly sharply. And if that's the case, not only can the economies survive on higher interest rates, I would say it's needed because of the amount of inflation that we are seeing coming in over the last year, and we're all feeling that at the grocery store. So I'm just trying to put into context what I'm telling you, that when you're managing your portfolio, and I'm just trying to give you some guidance here based upon my 40 years, you have to have a feeling and an awareness of what's going on in the world, and is it smooth sailing, or how much resistance are we going to go into? And so we have a number of things that we're going to be challenged by this year. Now, that said, we have some things that are going to go right, and you won't like it, me saying this, if you're a strong liberal Democrat, but the Republicans almost assuredly are going to take back the House and Senate. Certainly the House, I would say, but almost surely the House and Senate in November of this year. As we get closer to Election Day, I think the markets will react as it becomes more and more apparent that yes, and that is in fact going to happen. I think the markets will react positively to that. Now, I don't know what else will be going on in the world then. I don't know if we have another pandemic. I don't know if we have China and America and our allies, shooting at each other because of an attack on Taiwan. So if we're fighting China over Taiwan, the fact that the Republicans will capture Congress will mean very little. So, folks, we're just going to have to keep an eye on what's happening in the world as we manage our portfolios going forward in 2022. 2022 is going to be a much more challenging year for managing a portfolio than in general. I'm not talking about Humble. Humble is a kind of a case unto itself. But in general, the overall market, 2022 is going to be a more challenging year to make money than was 21 and 20. Now, I know my followers, so many of you are invested heavily in Humble, and that has been down for the now almost a whole year. And by the way, tomorrow, I'm reminding myself, this is January 24th, tomorrow marks my 1-year anniversary of creating the first video for this channel. So I'll have to think about doing something a little special on that. But that said, we've been down on Humble the whole year, basically, after a peak in February 8th, I think was the high watermark. But Humble could be the salvation of the portfolio in 2022. May not be. I'm not saying it will be. Where we are in Humble is we have to now see how the revenues come. And I've said this before, we could be pleasantly surprised. Hopefully we will be with the earnings that come out when they come out for the fourth quarter of 2021. But then we're going to have to take a look at what happens in the first quarter earnings of 22, which we won't get until about the middle of May. I know that's disappointing that we have to wait that long, but you have to be able to compare apples to apples. And so that's where we are. Hopefully, interest rates, just to wrap up, hopefully interest rates, while they go up, don't go up too much. Hopefully foreign powers, China, Russia, stay the hell out of other people's countries. And hopefully Iran also understands that it better not be developing a nuclear weapon. We have to look back, folks. We've survived World War II. We've survived all kinds of things. President Nixon's resigning, the challenges over so many years that we've seen play out. And all through those times, the American economy had its ups and downs. But as you can see, as happened over the last 50 years, it kept growing. And I would expect that we're going to continue over time to grow. So invest for the long term. Thanks, folks. Sorry for going so long. I was having some problem with my mic here, and I had to splice this together. But I did want to get back in touch with you because, like I said, I was kind of out of the loop for the last week. I know it's tough hanging on when the market is down, but this is why, again, I wanted to repeat some of the things that I was saying, because I think when you're experiencing the angst of the market going down, this is hopefully where the lessons I've been talking about over the last year make more sense to you, why you want to have a cash position, and that, of course, you want to buy things, assets, when they are on sale, and they're on sale when the market's down. As someone once said, it seems like only stocks are the only thing people don't want to buy when they're cheap. So this is where, and I did also have a video on this, that before the market sells off, you want to have a list of stocks that you would want to buy if the price comes down. For me, I think InMode, INMD, continues to be that, and that's the one that I would most pound the table on. I haven't looked at Ford. Ford is maybe having a rebirth because their electric pickup truck is getting a lot of orders. Let's see real quick. What is that? I've not been much of a buyer of Ford over the years. It's currently at $20.25. And over the last year, Ford has gone from about $10.50 to now $20. So right about a double. I'm not telling you to buy it here. I'm just saying you might keep an eye on that. But primarily my thing is InMode. And I think the oils still have a way to run. If you want to write me, there you go. If you haven't written to me before, if you want to follow me on Twitter, there is that. And with that, if you haven't subscribed, I hope you will. And in the meantime, take care, folks.